Two investors, same budget, same market. One buys a tired, dated property, rolls up their sleeves, renovates, and forces equity. The other buys a clean, ready to rent property, tenants it immediately, and gets on with life. 5 years later, who is actually ahead? This is one of the most common debates I have with investors, and the answer is almost never what people expect. Hi, I'm Ankit from ValueNest Buyers Agency, and I specialize in research-led property investment strategies. I help property investors make confident, data-driven decisions by focusing on numbers and fundamentals and not just the headlines. So let's get into it. Before we compare, let's define what we are actually talking about. Renovating for profit. You deliberately buy a property below market value because it needs work. You renovate cosmetically or structurally and either sell for a profit or hold at a higher valuation with stronger rental returns. Now, buying ready to rent, you buy a property in a good condition that a tenant can move into immediately. No works required. Your focus is on cash flow and long-term growth from day one. Both strategies work. Both have made investors wealthy, but they work in completely different ways and they suit very different investors. Now let's break them both down honestly. Let's start with renovation because on the surface it sounds like the obvious winner. And here is why investors are drawn to it. Firstly, you are buying below market value. A well-renovated property in a strong suburb was often purchased at a discount because most buyers don't want the hassle of a project. That discount is your starting advantage. You are manufacturing equity. Rather than waiting for the market to move, you are creating value through improvements. A $40,000 of cosmetic renovation, which includes new kitchen, fresh paint, updated bathrooms, new flooring, can add $80,000 to $120K in value in the right market. That is not a speculation, that is a manufactured outcome. Your rental yield improves too. A renovated property commands higher rent from a dated one. Better presentation attracts better tenants, low vacancy rates and stronger rent. And the numbers can be compelling. Let's say you buy a dated property for $750K, $50,000 below comparable renovated stock. You spend $60,000 on a cosmetic renovation. Post renovation, the value is $900K. You have turned a $810 all into a $900K asset. So post renovation, the value is sitting somewhere around $900K. So what you have done is you have turned a $810K property into a $900K asset. That's $90K of manufactured equity before the market moves a single dollar. For investors who want to accelerate their portfolio faster than the market allows, renovation done right is a genuine wealth accelerator. But there are a lot of risks around it. And here is what I want to be straight with you, because renovation is also where I have seen investors lose money badly. Cost blowouts destroy the margins. A $40K renovation budget can become $65K faster than you think. Unexpected structural issues, rising material cost, trades not showing up, every delay costs you holding costs, which is on top of your renovation spend. Overcapitalizing is also a real trap. Spending $120K on a renovation project in a suburb where renovated properties sell only for $80K more than the unrenovated ones. So here you have just lost $40K. This market sets the ceiling, not your taste. It takes time and time costs money. While your property sits vacant during renovation, you are paying the mortgage with no rental income. A 3-month renovation can cost $10,000 to $15,000 in holding costs alone before a single tradie picks up a tool. And it requires active management as well. Coordinating trades, managing timelines, making decisions weekly. This is not a passive strategy. If you are time poor or if you don't have experience managing a renovation, the execution risk is significant. The margin of error is thin, and getting into wrong doesn't just cost you money, it costs you time you can't get back. Now let's look at the other side, buying ready to rent. And I want to make the case for this properly because it is often underestimated. The first advantage is speed. Settlement happens, tenant moves in, rental income starts, you are cash flowing from week one. With no renovation stress, no tradies, no delays. The holding cost argument is powerful here. Every week a renovation property sits vacant, a ready to rent property is generating income. Over a 6-month renovation period, that's a meaningful difference to your cash flow position. You can focus entirely on location quality. Without the distraction of renovation upside, you can zero in on what actually drives long-term wealth. Buying the right asset in the right suburb, infrastructure, employment, population growth, supply constraints. These fundamentals always outperform a good renovation over a 10-year horizon. The ongoing management burden is lower as well. A well-maintained, modern property attracts quality tenants, generates fewer maintenance calls, and gives you your time back. For investors with busy careers or families, this is genuinely valuable. And the compounding effect is real. A quality, ready-to-buy property in a strong growth corridor held for 10 years can deliver extraordinary returns without you lifting a single paintbrush. Sometimes the best investment decision is the one that lets you do nothing and still win. Let's look at the limitations. So buying ready-to-rent properties comes with a lot of limitations. Firstly, you are paying full market price. There is no discount for taking on a project. You are buying what everyone else wants and you are paying for it. Growth is entirely market dependent. If the suburb underperforms or the market goes sideways for 5 years, you have no manufactured equity to fall back on. You are just waiting. Yield can be underwhelming. Clean, well-presented properties in strong growth areas often come with modest yields. Cash flow can still be tight, especially in the early years and today's interest rates, and there is less to do. For investors who want to feel actively involved in building their wealth, the passive nature of this strategy can feel frustrating. Patience is a genuine skill, but not everyone has it. Now let's put both the strategies head to head. Speed to income, ready to rent, immediate. Renovation, weeks to months to vacancy. Equity creation, when you talk about renovation, active and manufactured. Ready to rent properties, passive, market driven. Risk level, renovation, higher execution risk. Ready to rent properties, lower execution risk, market risk remains. Time commitment, in the renovation project, significant during the project. Ready to rent properties, minimal ongoing. Skill required, renovation, yes, project management is required, trades are required, feasibility needs to be done. For ready to rent properties, property selection matters and location analysis is the most important thing. Best suited for renovation is best suited for investors with time, experience, strong local knowledge and a reliable trades network. Ready to rent properties, investors who are time poor, earlier in their journey or want to focus purely on location quality. So let's look at the honest verdict. Over a short time frame, 3 to 5 years, a well-executed renovation can outperform a ready-to-rent purchase significantly. Over a 10 to 15 years horizon, a quality ready-to-rent property in the right location will often close that gap completely. The renovation gives you a head start. The location determines where you finish. So how do you actually decide which one is right for you? If you are buying your first or second investment property, I would lean towards ready-to-rent. Focus on getting into the right market in the right location at the right price. Build your foundation before you take on project complexity. If you've got equity behind you, a reliable trades network and genuine experience managing a renovation, then buying a renovator is a strong suburb can be a powerful way of manufacturing equity quickly and accelerate your portfolio. If you're time poor, a demanding career, young kids, a full life, ready to rent is almost certainly the better fit. The mental load of a renovation project is real and underestimating it is one of the most common mistakes that I see. And here is a hybrid worth considering. Some investors buy ready to rent, get a tenant in immediately and do a light cosmetic refresh between tenancies 12 months later. You get the income from day one and you still capture some renovation upside without the full vacant property risk. It's not always an either or decision. Here's the truth about both strategies. Neither one wins universally. The renovation investors who buy smart, manages well, or doesn't overcapitalize can build equity faster than almost any other strategy. But the ready-to-rent investor who buys in the right location and simply holds patiently, consistently, will almost always come out ahead of the renovator who gets the numbers wrong. The best strategy is the one you can execute well with the time, skills, and team you actually have, not the one that looks best on paper. So if you're trying to figure out which approach fits your situation, that's exactly the conversation I have with investors every week. Drop a comment below. Are you a renovator or a ready-to-rent investor? I would love to know. And if this video was useful to you, please subscribe. We do new videos every week. See you in the next one. Thank you.